There is a cyclical element to fraud, right? Because in good times, people look the other way, and
I don't.
right?
I don't think it's cyclical. I think it's always there. I just
Okay.
think who was it said when the water goes out, you can figure out who's swimming nude.
I think
That's
that's Buffett,
Buffett.
It was
right?
Buffett. Yeah,
Yeah.
yeah,
Well, Galbraith, however, talked about the bezel, right?
Basel.
The propensity of flim-flams and scams to exist during the good times, and
yeah.
people just like don't, and that accumulates and accumulates, and
That could
we've
be.
had like 20 years, as you said, like we haven't
Yeah.
had a credit cycle. I mean, it's almost 20 years since the financial crisis now.
Yeah, the finance always finds a way to blow itself up. I mean, it's.
Yeah.
I mean,
Yeah.
it's not a opinion. You just
Right.
look at history. I think what happens is you get we find good things and then you ride them, and
Yeah.
in every instance where something's gone wrong, you just keep pushing on something till you take it over the edge. Right? Finance is an industry where historically you can make a lot of money at it. Right? You're playing with other people's money. Pennies and nickels come off of other people's money. I'm just going to keep pushing. I'm going to keep pushing. I'm keep pushing. When it finally falls, it falls hard.
Hello, and welcome to another episode of the Odd Lots podcast. I'm Joe Weisenthal.
And I'm Tracy Alloway.
So, Tracy, one of the motifs, I guess, of some of our recent conversations.
Motif is a good word.
Yeah, it's a good word, isn't it? Thank you. One of the motifs of some of our recent conversations, and also, I guess, one of the mega trends of our time is this idea of just like scale as a competitive advantage. Size, returns to scale, the ability of someone to like pick up a phone and say, I need a lot of money right now, and the advantage that accrues to financial players. We see it across a lot of sectors, but it stands out a lot in our finance conversations.
It feels good to be big
Yeah,
in
yeah.
business, right? Like once you get big, you have all this competitive advantage that
Yeah.
allows you to get bigger. The place where this is most noticeable, I would argue, and it's been this way for a while, is the banking industry, right? Like
Yeah.
the long run trend among US banks is the big get bigger. And we've all seen those charts of like
Yep.
all the little banks that compose Bank of America or a JPMorgan. I love those charts, by
I
the
do
way.
too.
And that's the direction the industry seems to be heading, right?
Right. It's so interesting to me to think about like these and analogs with tech, because it's the same in tech, right? If you look at big tech and we talk about the Mag 7, et cetera, they've really outperformed middle tech or small tech. It is truly incredible. And we have intuitive reasons for understanding of that, network effects, lock-in, and so forth. And it's so fascinating that some of our story that we tell in tech must be a little bit insufficient because we see the same story replicated as we're talking about with banks. And with banks, it seems to be a couple fold. As like one is balance sheet capacity, right, and the ability to do big deals and so forth. And then, of course, there's the other thing, which is just like the sort of the menu of services that you can offer a
Right.
client if you're a big bank.
Right. And also just the fact that you have, balance sheet, you have a lot of money. So if a juicy deal comes
Yeah,
up, you
totally.
can deploy it quite quickly and you get like first dibs on issuance, which has been good in the recent credit market.
So we haven't done like a ton of pure banking episodes, although we've done some. But we did the most probably right in the wake of Silicon Valley Bank, obviously, and we talked about like the challenges of some of the community banks or the sort of smaller regional banks, et cetera. And then we know like the huge scale of like the JPMorgans of the world, but also like what about the banks like just sort of like sub JPMorgan scale, not
Super regionals, I believe they're called.
super regionals, interesting perspectives of their own. And so, and I've always said, I love talking to bankers, people who understand how banking works, just like I think they're usually some of our most interesting guests.
Have you looked at the KBW Bank Index, by the way?
Not today. Actually, not in a few days, or maybe not
Not
even
in
a
a
few
few
weeks.
days.
Yeah, how's it been doing?
It's up quite a lot. In
Yeah.
fact, I think over the past 12 months, it's outperformed the S&P 500. So
Wow.
that kind of tells you how people feel about banks and bank regulation at the moment.
Absolutely right. One of the things when Trump won was the sort of like the deregulation trade, and that was one element. And arguably, I would say in finance, by and large, although 10% credit card caps does not scream deregulation, I would say that's one of the areas in which the expectations of Wall Street have actually been met by and large by this administration. Anyway, I'm very excited to say it. We really do have the perfect guest to talk about the banking world in 2026. We're going to be speaking with Bill Demchak, CEO of PNC Financial, which is the 6th biggest bank in the country, I guess a super regional. So, Bill, thank you so much for coming on Outlaws.
It's great to be here, but I'm going to correct you. We're a national bank.
National bank.
Yeah.
Why did I say super regional? Were you once that?
Yeah, because we have the mega banks and people don't know what to call somebody like us. But
Yeah.
we're in.
I always thought super regional was just like that category below the mega banks.
But I mean, a regional bank is a bank that operates in a region.
Okay.
Right. We're across the country. We're in the largest MSAs. We're in every state. We're just 1/6 the size of a JPMorgan.
Got it.
But we're still a national bank.
Excellent. Well, since we're in the correcting the record phase of the conversation, I'm certainly familiar with the PNC brand. You see it on things elsewhere, probably like a stadium somewhere. Is there a stadium somewhere?
We have PNC Park for the
There you
Pirates.
go. PNC Park. So there you go. But why don't you just give us the big overview? Like, what is PNC Financial?
We are a traditional bank. We used to call it Main Street Bank. Maybe that fits, maybe it doesn't. But, we help people save, we lend money, we do investments, we move money through payments. We're a bank that aspires to be, coast to coast with a retail presence as retail share consolidates in the U.S. Our sweet spot is larger middle market, smaller large corporate, but of course we do commercial and business banking. We're active in the capital markets across basically every product but new equity issuance. But more of a traditional bank. So when we talk about you were talking about scale in your intro. Think of JPMorgan. They've got to be in 50 countries. Right. They're in multiple lines of business beyond traditional banking. We have scale in what we want to do. So there's scale in the things you choose to attack versus scale just measuring balance sheet size.
Got it.
You have been growing, though. You made an acquisition recently, FirstBank. Is the ambition to be, as big as some of the G-SIBs, like the national giants, let's say?
The ambition isn't about size. The ambition is about being relevant. So one of the things going on backdrop to the U.S. market in particular is there has been consolidation in retail share and banking, ever since they got rid of interstate banking laws. That continues apace with the mega banks largely winning at the expense of the very small banks. And so at some point in the not too distant future, I suspect that there's going to be 5 or 6 players who control retail in the U.S.
The Canada model.
Yeah. And our aspiration, and we're on pace to do it, and we think we can do it, is to be one of those 5 or 6 banks. What size that leads to, I don't care. You just need to be relevant to consumers everywhere in the country, and you shouldn't be disadvantaged because you don't have presence in a particular market.
How would you articulate why the really big banks continue to win share of the retail market? I could come up with some answer, but how would you describe it?
It's ubiquitous market presence. Once you get over 7% branch density in a particular market, you tend to outperform under the assumption you have an okay reputation and decent products. That you don't have to have the best, but you have to have the menu of all the digital applications, digital signature branches in the right place, electronic transfer, all the things you come to expect from the bank you guys probably bank at. You get there and you grow. And if you think about that definition, there's only 3 or 4 banks today, actually only 2 that fit that definition.
JPMorgan
and B of A. Now Wells has the potential, now that they've gotten rid of the asset cap and so forth, to continue to grow. And then you have some aspirants who'd like to get in there. We're clearly one of those, and one of the people who's been after this game probably longer than most.
Just sorry, what was the metric that you cited? 7% branch density. What does that mean?
Yeah. So by the way, we use 7%. Other banks will talk about 8%, but it's somewhere around there. You get to a place where if you have presence in a market, 7 or 8% of the share of just physical presence
branches
with decent products, you control a disproportionate share of the actual deposits and economics coming out of that market.
So I'm actually surprised to hear that, because the story, that's dominated since the financial crisis has basically been that physical branches don't matter that much.
Yeah. So you've seen across the U.S., net closures of branches is off the charts relative to new builds. But what you see behind the scenes is somebody like PNC, where we are, if you think about our very dense markets where we've been for 165 years, we're thinning those branches because you don't need as much. But we're building aggressively in Houston and Dallas and Miami. We were building in Denver till we bought FirstBank. So going to all these growing markets where the population's moving.
Man, it just occurred to me, I already, after we do this episode, I want to follow up and do an interview with whoever your main person doing site selection is, because we've done episodes on retail drive-through site selection, and grocery store site selection.
We have a great team. We're building, but by the way, we've announced we're building 300 branches in these new markets. And as an aside, once we knock 100 off, we'll add another 100. So it's going to keep going. We're probably 1,000 short of where we ultimately want to be, but we don't have to be there tomorrow. But just building 100 branches a year is a massive exercise on site selection.
Yeah, you're a construction company.
Yes. I mean, exactly right. So you need to pick the right location. You need to choose whether you're going to do a drive-through or you're going to be at the end of some shopping something where you're kind of an end add-on to a new development. The physical, we have preset designs, so we know what we're building, but you still need a contractor. You need somebody running at the physical plant that you move into the branch. We have pods now. New branch opens, truck with a pod shows up, and everything that branch needs to run, from computers to paper to pens, is in a pod. Just deliver it right into the branch, which is what we're going to do when we do the FirstBank conversion, as an aside.
Oh, that's really interesting.
Yeah.
Let's talk about bank regulation, because I think this is
fun.
Very fun. This is part of the consolidation story, I think, is that even though post-financial crisis, there was more focus on the significant banks, the GSIBs. At the same time, those GSIBs seem to have benefited from some of the regulation.
Yeah.
Is that how you would characterize it?
I don't know that they benefited from regulation. They had to carry extra capital. They clearly, in times of crisis, have done better than the broad swath of smaller banks, as we saw with Silicon Valley and some others. But they were sort of walled off from competitors. So, I've talked for years about just the need to be able to compete. Some of that competition comes from M&A. Some of it just needs to, the ability to do certain activities. And in theory now, we're in an environment where it's easier to do that. And I think practically that's probably true, although I would tell you, I think we could have done large deals had we chosen to back during the Biden administration. I think people tend, one of the sound bites that comes out of regulators is good deals are okay, bad deals aren't. But they won't tell you what a bad deal is. But a good deal is typically when you have one bank, one good bank, somebody's in charge. Yeah. You have technology that can actually absorb the other bank, and you can protect consumers and so on and so forth. Those could have gotten done in the last administration.
That's interesting. Well, let's talk more about your philosophy of M&A, because your stock has done very well, but it has for a while, especially in the last year, up until recently, had been underperforming some of the other banks. And your quote is everyone thinks we're going to do some that's not an exact quote, but it's something. Why does everyone?
The whole
keep
world's
saying,
betting I'm stupid.
Yeah, right. But then how do you grow? So, all the market, they don't want to pay up for your stock because they think that you're going to do some stupid
This isn't complex. We'll just start with the basics.
Yeah, all right.
Last year, we outperformed, I think, everybody, including JPMorgan, in top-line revenue growth and EPS, PP&R growth.
What's PP&R?
Sorry. You think I would know. Pre-provision net revenue.
Okay, keep going.
Fantastic year. We set records in new client acquisition, revenue growth, expense control, great new tech rollout and stuff, and we underperformed. Part of the backdrop of that was the mega banks outperformed as people correctly thought regulation was going to drop and they could return more capital than they historically had. So take that bucket. They're doing great because they have all this capital and they're free to do whatever they want to. Smaller banks went up in value because, people like Bill Demchak with a big mouth said there's going to be consolidation, so everybody's going to buy them. So they go up in value. Yeah. And because we are a likely acquirer, given our historical performance and being good at integration, we get crushed.
Did you get penalized from the perception of a more liberal M&A attitude?
Absolutely. But part of it's my fault. And, because I talk about the need for scale. I talk about the consolidation that's happening in retail. I talk about why this makes sense. And people make this leap and therefore end the sentence with "at any cost." And that's a terrible assumption. Not at any cost. We can do this organically. It just takes longer. And, today with everything flying in value and us underperforming, it's extremely unlikely we find something that makes economic sense for us. Plus the fact, just as an aside, the environment is so good right now. None of the reasonable sized banks want to sell. This is like a sunny day in August, man. You got, rates are going the right way. The curve is steepening out. Credit's great. Regulations coming down. Nobody sells their bank in that environment.
Do you wake up every morning and check the PNC share price? I always wonder about this. CEOs of public companies, you're graded instantaneously by the market.
Yes, but the market at times is an unfair grader, so I don't pay attention to it. I look at metrics all the time. Are we winning clients? Are we automating things and getting more efficient? Is our marketing campaign reaching people? What's our traction level in digital? All these things that ultimately will lead to a share price performance, but not in the day.
Well, let's talk then a little bit about, okay, so a lot of banks are doing well. They don't want to sell. Yeah. You're not a stupid guy, so you don't want to make like a dumb deal.
So there's not going to be deals.
What?
So there's not going to be deals.
So there's not going to be deals. Yeah. Okay, so yet you have this aspiration to be one of the really big banks, and so okay, that leaves organic growth. What is the?
But it also, in perspective, right? Sure. We're in this the weird window in regulatory change isn't the Trump administration, it was the Biden administration. Anytime before Biden and now after Biden, deals get done all the time. We're 165 years in business. The little chart you talked about with all the banks? Yeah. We've got to have 150 banks under us through time, and that'll continue. But it doesn't have to happen now, right? The weird thing about now is just we ended the 4 years of strange period under Biden.
Got it.
Now we're just back to the old game. This will go go on and on and on.
So what is the essence of the organic growth strategy to grow?
So so far I've been talking about retail. Let me talk about the reason for retail. So ultimate reason for retail is retail deposits. Retail deposits are low cost. They're sticky. They allow you to support your corporate community and consumers with loans. We've been able to win in what we call our CNIB business, a corporate institutional bank business, gain share every year for the last, 15 years in what is a very fragmented market. We talk about the mega banks gathering retail share, but in corporate commercial, nobody has any real share. It's shotgunned everywhere. And we win in that space, and we do it by, going to market locally. We organize, this will all sound kind of silly, but we don't have P&Ls by product. We have P&Ls by client. We go into the market. We have a regional president. We have product expertise, and we choose the most important and impressive clients to cover in that market. Not anybody else. We don't do business with somebody necessarily who walks through the door because that's all that we'll do business with. We'll call on the same grade A client, that you want to cover if you're in Miami or you're in Texas. We'll call on them for 10 years until they call us back. Patience, persistence, consistency, good product ideas, our real low banker turnover, and we win. And you just, rinse and repeat. Go into new markets, add people, keep growing.
Just on acquisitions, I'm really curious how difficult it is to integrate another bank with your company? Because you just
Yep.
said you're good at integration. What does that actually entail?
That's a great question. So integration, there's a mechanical component, and then, of course, there's a cultural component. Mechanical component should otherwise be easy, but is proven difficult for some people over time. The mechanical component, let's just talk about FirstBank for us. We simply take all of their data records, so, record field data items that for one of their checking accounts, and we import that data, but we don't import that application. All that data comes into PNC, and then over a weekend, we simply open up 1 million new accounts on our existing products and services. Sounds pretty simple. If you can move the data, you can just effectively open new accounts. My team will scream, it's not that easy, but that's basically what you do.
Looks easy to you.
Yeah. Now all of a sudden, okay, now we have all these customers with new accounts. How do they log in? How do they learn? Like our online is different than somebody else's online. So now you're getting into training modules, communications with clients, training their branches. With FirstBank, tremendous frontline set of people, incredible bank in history. We're keeping all their client-facing employees. Now they all of a sudden have to know the difference between PNC products and their old products. So how do we do that? That's what integration ultimately means. There's a mechanical piece of it, get the systems to work. So you turn it on and the lights go on. There's delivering pods to the branches, so they have all the PNC equipment and the signage and all that other stuff. But there's a lot of time with people. We send in branch buddies. So we'll take branch managers from all around the country and go have them spend, a couple of weeks in each, sitting with the branches at FirstBank.
That's
just
the
helping
cultural
people.
aspect of integration.
And the learning. And banking, in some ways is simple. In some ways it's wildly complex. An employee in a branch, the problems that you might walk in, right? You say, I rarely go into a branch or I don't think about it. But when you go into a branch, something's really busted.
Yeah.
So the employees,
This is true.
right, they need to know how to fix it. And that's when we say we're good at integrations, it's because we focus on making sure that our new teammates know how to do their job and can help their clients. Because they have the same clients they've had forever. They don't want to look bad in their new role.
Can you actually just talk more about that? So it's like, okay, they need to know how to sell or be familiar with the PNC product now. Talk a little bit more about what that difference is, what actually changes functionally, why it wouldn't be what it is about either culture or products such that it's not just replacing the logo and the pens and the notepads.
Well, everything works at the margin slightly different. Checking account's a checking account. But imagine you're in a branch or you're in the care center or you have a problem. You made your car payment, you sent it through snail, it was time-stamped the right time, but it went through snail mail, got lost, you got penalized a fee, and you go into the branch and you say, it's really not fair, I sent this, and you're hitting me with a fee. And the branch person, what do? Right? There's some answer to that. What's our procedure? Well, now with AI, you can just go into a large language model that is built off of all of our customer service protocols and say, what do I do? This just happened. It'll tell you, credit the customer the fee and send a note to the, whatever the answer is for that particular problem. Mm-hmm. But the person sitting there needs to know, which system do I query? What's my browser? Who do I talk to? If I'm going to make an exception, do I go to the branch manager or can we do that here? Or do I got to call somebody in some strange room in a back office in Philadelphia? All of that with us, because we automate so much of it, is now kind of query and self-learning in the branch, and then importantly, more and more with our customers, self-curing. They got locked out. Just be able to fix the problem yourself.
One thing I've wondered for a few years, does local expertise matter anymore when it comes to actual underwriting, either in retail or commercial? Because I think most of America used to have this very romanticized notion of the banks, the sort of It's a Wonderful Life model where your branch manager knows you and knows your entire life and business and all of that. My sense is that doesn't exist so much anymore, but tell me if I'm wrong.
You're wrong.
Okay.
It's harder to accomplish when you become a larger bank, but how has credit evolved through time? Consumers now, if they're an existing client of you, are scored based on their cash flows that you see. So not a FICO score. You can actually see when did somebody pay the rent, are their spending patterns predictable. You can build models that say, you know what, this person is a really diligent, good credit, even though it might not show up in a FICO. Local market business, you're going to lend to this small developer, you're going to lend to this store on the corner. Branches really matter, and local bankers matter for small businesses because they see where the foot traffic is. They know the reputation of the person who's running that business. Do people, you know, are they a community influencer in a good way where they're, you know, people want to support them? All that stuff still matters. And all that stuff, the more you can give somebody voice locally in the decision, I always kind of call it putting a thumb on the scale a little bit on a yes or no that's otherwise mechanical, the better your credit underwriting is.
Well, since we're talking about consumer credit, what happens to the world? What happens to America or the industry if there's a 10% cap on credit card rates as President Trump has proposed?
So the only thing I know for sure, if that happens, is that all the credit card businesses in the country lose money if run exactly the way they are today. So we have, you know, credit card business, I get swipe fees. I give most of those away with rewards. I earn credit when somebody is revolving a balance. I lend credit when somebody pays it at the end of the month, right? I'm fronting that money for you if you clear your account every month, but hopefully I'm getting some swipe fees to make that good. After all that, you charge interest rates, you have losses, and you get a margin, maybe you make 4%. And assume interest rate, I'm making up numbers here, but assume maybe the average rate is 18%, I make 4 at the bottom, now I'm going to take my 18, I'm going to drop it to 10. Uh-oh, I just made -4. And so all that math is going to come out, which is why I don't think this goes, like there's almost no way this can happen. You'll just simply shut down consumer credit in the U.S. They can't force, they could say the cap is 10%, and I'll say, fine, I'm out. Like, why would I do it if I'm going to lose 4% a year on that? Something's going to change. Fees are going to go up. Lines are going to get cut. Rewards will go away. You know, and something will emerge out of the dust, but it's not going to look at all like it does today.
What do you think the genesis of the proposal or the rationale behind it actually is if, you know, everyone in the industry says this basically ends credit cards?
Yeah, I think because, first of all, the emotional appeal of it. I mean, it sounds absurd that you're charging somebody 18% for a revolving credit. Like, I think that sounds high. That happens to be the rate that you need to charge to make money, but it sounds, which is why I never revolve a balance. I pay it off every month. So there's this emotional appeal. Geez, you ought to be able to lend, like, I'll lend money to you at 10%. I'll lend money to you at 10%.
Thanks.
Right, but I can't necessarily figure out who you are in a sea of people. Right, there's a bunch of people I'll lend money at 4% because they'll never default. You know, so that's the issue when you try to get to the broader population and extend credit to the consumer that drives our economy. Science isn't so exact to say you get 9 and you're 22. I don't know about you.
Well, actually, I want to press this further because intuitively, I would think you'd be able to do that. You just mentioned the fact that you have granular access to propensity to pay back that is not even captured by FICO. You have incredible amounts of data and predictive capacity on the difference between whether me or Tracy are going to revolve. So when someone says 18% seems high, are we supposed to just like believe, oh, just trust me, it's high. This is what I need to charge in order to make money in this business. I mean, I could trust you, but like, how would you?
But the math is the math.
Okay.
At the end result, right, you say, when you run your models and you look at, you know, propensity to pay you back, you basically, you know, whether you're looking at FICO or anything else, FICO is only as good as whether that person has a job next week, right? They, you know, you can look at predictability and yes, this person has been paying their rent. They have a steady expenditure thing on food and on gas and on entertainment, and their savings account balances always stay pretty steady. That ought to be a good credit. Well, it isn't a good credit if they get fired or lose their job because the economy's in a downturn and all of a sudden, well, I thought that was a really good credit. I should charge 5%. Turns out I just wrote the whole thing off because there's no recovery value in that credit. That's where the science fails. There's exogenous variables you can't model. And the wider you cast the net, right, the bigger the dispersion on outcomes. However, if we've settled there, that interest rate kind of sets a reasonable profit margin. The largest card issuer in the country, you can figure out who this is, right? Best at it, best computer models, best finding credit, best extending credit to non-prime borrowers. They trade at 1x book value. If this was a genius business, like that's way too much, I'd drop the rate by 1%, and grow share. The problem is it's not so great, actually.
I want to talk about private credit a little bit, because obviously this is an area where we always hear about banks face new competition from middle market lenders and all of that. But at the same time, we also see banks teaming up with private credit now, and it seems to have
also.
Yeah. Okay. Talk us through that relationship.
Yeah. So traditionally, standalone high yield credit, if all you did was walk around and just lend money with no particular expertise, but across leverage clients at a single big credit, that's a really lousy return on capital, right? All the science going back to when Moody's started tracking this stuff in the 80s, you get kind of a 35% recovery, you have a 10% default rate, you go through cycles, sometimes a lot worse, sometimes a lot better. It's not a particularly good business. Becomes a better business and sometimes a fantastic business if you couple that with the wallet that goes with that company beyond just the credit. So IPOs, M&A fees, bond fee, whatever the stuff is that goes along with it, all of a sudden it becomes a pretty good business. What's happened in the last couple of years, we've seen this drift into more and more credit leaving banks, going into private equity and other alternative forms. At PNC, it manifested itself where we'd have a client that we might have banked for 100 years, owned by third-generation family, that just got sold to private equity, and our client's gone. Because I don't want to make that loan at that leverage ratio, and whoever does make the loan is going to demand the treasury management relationship and all the other stuff that goes with that client. So where we come out at it is I don't know that I necessarily want to make the loan. I will sometimes, but I want to keep the relationship. So our partnership with TCW, as an example, is when that happens now, we put capital in the TCW fund, as did a bunch of other people, but happens now, we'll keep the client. We'll diversify the credit risk, but keep the fees. So the return on equity on that this thing, goes way up. The whole notion, remember, like private credit in the last 3 years, oh my God, it's a new thing. We're great at it. We're going to make you a fortune. Why is that? Private equity kind of hit the skids. Nothing was getting sold. They need to raise new money. We haven't had defaults in 10 years. So a manager shows up and says, look at my track record. I can earn, with 2x leverage, I'll give you 10% return after fees. This is fantastic. Private equity sucks. Come with me. Of course, we haven't had a credit cycle in 10 years, so those stats are all garbage.
Yeah.
Actually go through a credit cycle and you have 2x leverage on that thing and you start having defaults, which we've had a few of. All of a sudden, it's not really exciting.
Can I ask one macro question in this conversation,
please,
which is where do you think we are in the credit cycle at the moment?
I've given up trying to predict it. Credit today is pretty good, better than pretty good. A lot of the leverage that's in this system that everybody complains about are actually with things that are very good enterprise value. So I don't worry so much about the disappearance of a company. I think about it in terms of reallocation of the ownership structure. Right? If they're over levered, they go down. Either private equity firm bails them out, or they say, no, here are the keys, and now the debt holder owns them, and then the debt holder restructures the debt and sells them again. Somebody lost money, but the company's still a good company. It was just over levered to go. Most of the noise you're hearing right now on credit, beyond the fraud, the cockroaches that Jamie said come out when things get stretched, most of it are decent enterprises, just over levered. And then, of course, you have the fraud. You haven't had anything that's really going down today because the economy just crashed in a spot, other than some isolated issues with tariffs.
There is a cyclical element to fraud, right? Because in good times, people look the other way, and
I don't think it's cyclical. I think it's always there. I just think the who was it said, when the water goes out, you can figure out who's swimming nude?
I think that was
That's
Buffett.
Buffett.
It was
Right?
Buffett. Yeah.
Well, Galbraith, however, talked about the Basel, right?
The Basel.
The propensity of flim-flams and scams to exist during the good times, and people just like don't, and that accumulates and accumulates.
That could be.
We've had like 20 years, as you said, like we haven't had a credit cycle. I mean, it's almost 20 years since the financial crisis now.
Yeah, the finance always finds a way to blow itself up. I mean, it's I mean, it's not a opinion. You just look at history. I think what happens is you get we find good things and then you ride them, and in every instance where something's gone wrong, you just keep pushing on something till you take it over the edge. Right? Finance is an industry where historically you can make a lot of money at it, right? You're playing with other people's money, pennies and nickels come off of other people's money. I'm just going to keep pushing. I'm going to keep pushing. I'm keep pushing. When it finally falls, it falls hard. We haven't had that. What's the new thing? Now it's fintech and it's crypto and it's, banking has been kind of throttled by regulation for 10 years.
Well, speaking of finance, always finding a way to blow itself up. Can we talk about Silicon Valley Bank in 2023? Because, they managed to blow themselves up for a variety of reasons, but one of them was they just had too many bonds, which is kind of, an unusual one. What was that experience like for you, first of all?
Let's go back to Silicon Valley. I actually think they had a great institution. They had a unique...
Who's been saying that? Who's been saying that many times on this podcast?
Wrong.
The Silicon Valley Bank respecters. Okay, keep going.
No, it's just it was a unique business model with a very loyal client base that they...
Not that loyal in the end.
I mean, look, if you're dying, loyalty goes out the window. But they blew themselves up in something that was not at all core to their basic business, right? Interest rates are super low. They got as long, by some calculations, as like long-term capital was back in the 90s. I mean, they were really, really levered and underestimated the negative convexity deposits, right? You think, on average through the cycle, they're going to be there 7 years. Oops, they're gone tomorrow. And so they blew themselves up on rates that had nothing to do with their core competence or what they were as a franchise. And it's unfortunate. But I mean, it was rookie mistake. There was nothing. It's just a crazy position to be in.
How scary, those days afterwards, and then people started hunting for like any bank that had the word California in the name, like people were shorting it or people were selling it.
You had headlines where, the regional bank index, that's why I'm a national bank. We are not a regional bank, because the next time they put regional bank headlines in there, I don't want to be associated.
Yeah, I get it.
No, we actually benefited during that. We're a safe haven, and we actually gathered deposits and opened thousands of new accounts during that period of time. And then every day somebody would flash the regional bank index, and we'd get blasted on our valuation, which is fine. It always, valuations are short term. It all came ripping back after that.
So one of the issues that came up during the 2023 banking drama, I guess, is the discount window. And banks' reluctance collectively to use it. And this is something that the Fed's been trying to change, right? And actually, do you remember in late 2022, there was a big spike in tapping usage of the discount window. And it turned out that wasn't any of the banks that ended up getting into trouble. It was Beal Bank down in Texas.
It's a weird bank.
Yeah, it's a very weird bank. But anyway, regulators trying to get banks to use the discount window more, feel more comfortable with it. How do you feel about it?
Well, that's a great question. So before the financial crisis and before regulation and LCR and long-term debt proposals and all that other stuff, there was a very active Fed funds market. So in a given day, the excess reserve a bank would hold deposited in its Fed account was tiny. And we would trade Fed funds around with each other. If I needed $2 billion, you'd give me $2 billion. Next day, I might give you $2 billion, like big size Fed fund positions. And that's how you balanced your books at the end of every night. And then they come out and they say, hang on, we don't want you doing that anymore. There's an LCR requirement. You have to have this much liquidity stuck aside instead of going into the Fed funds market. that gave rise to all these excess reserves. Fed fund market is basically dead. The Fed sets that rate. Nobody trades on that rate. It's as dead as LIBOR. It's gone. I don't even know why they talk about it anymore. Now you have, they basically said you don't use the discount window and hold all this cash. You just froze the economy because you stopped the circulation of capital transformation. Home loan banks step in. Because I have to hold all of these treasuries and mortgage securities, I can pledge them to home loan and they'll lend me money at a pretty good rate. So that's going to be my outlet. I'm going to go to home loan and I'm just going to borrow there at a pretty good rate, or I'm going to repo my treasuries that I hold. Silicon Valley happens, and they had home loan lines. They didn't have any discount window lines. Now, the discount window will lend against treasuries and agencies pretty simply because it's basically settled electronically through effectively the FedWire system. If you're pledging loans, it's really hard to pledge. So if all I have is securities to pledge, I should just repo them or I'll give them to the home loan bank. Discount window will do more than that. But if I want to draw against my loan balance, I need to give them physical wet signature loan docs in a vault,
Wow.
Really?
guarded, audited, 24 hours a day. Like there's got to be a guard and I have wet signatures stacked up. So they know that when I draw against that loan, I actually have that loan because it doesn't settle FedWire like a bond does. This is a loan, right? I lend you money, you sign the thing, I put it in the drawer somewhere. Then you say, all right, let's pre-position these loans. PNC spent millions and millions and millions of dollars. So the vast majority of our C&I loans are now at the discount window.
Huh.
We don't borrow under them, but they're there. If we wanted to borrow under them, I got to call. It's gotten a little better. Well, hang on.
So
You
you're-
gotta finish it then.
I got to
Yeah.
finish the
Yeah,
story.
yeah,
It's
yeah.
gotten a little better, but basically, like during COVID, or post-COVID, when nobody was coming into the office, you'd call. Like the way you borrow from the discount window is you call Cleveland. They're our Fed, 12th district, and then they say, "Oh, okay, yes, you're in good shape. We'll allow Washington to allow you to use the discount window," and then they'll call Washington, and then maybe like a day or so later, you can have money. When nobody was coming into the office, nobody would answer the phone. I got to draw in the discount window. That just rings. Nobody's there. God, there's no system. It's not like I can type in and draw. It's not like I can do a Fed funds trade through a broker and draw the money. It's unusable.
But
You-
now you're pre-positioned
Yeah.
to borrow against loans if you need to.
Yeah, we have enough liquidity on hand basically to cover anything that can happen because we positioned all of our collateral in the optimal spots.
And
Plus,
you're
we
talking
had
about
this
this is
cash.
what I was getting. Are you talking about physical spots? When you say you because you're talking about like wet signature documents.
Yeah, so the only place you can borrow against C&I loans in effect is the discount window. So, so they're going to go over there. That's wet signature. I can borrow against securities in the repo market, at the home loan, or the Fed. So this is kind of the confusion that happened with where was stuff pledged with Silicon Valley. I have, $50 billion of cash sitting on the Fed's excess reserve book, so that's instant liquidity, and I own a whole bunch of treasuries that I can sell if I had to. So you figure out, how do I optimally earn whatever I can on these assets I'm pre-positioning, but get them in the right place so if I need liquidity in an emergency, I can get it. Silicon Valley did not do that, and the Fed did not make it easy for them to do that.
And I'm just trying to be clear. When you say get them in the right place, you mean like a physical place?
Some of it's physical, like the loans, the wet signature
Yeah.
loans. I literally think we take them down to like a vault and spin a dial, with the big crank,
Yeah,
and they
yeah.
get locked in there. But no, securities by QSIP, you would say like this batch of QSIPs is pre-positioned with the Fed, so I just know where they are. I know the balances. I know I can send them right over FedWire and draw on that. So it's that thing. Yeah.
One thing I always wondered with the discount window, so part of the reluctance historically to tap it on the part of banks has been they're worried it'll get out into the market, right? And there'll be rumors that they're tapping the
crazy.
market. How does that actually happen? I don't understand
Well, so
how
they
that
can-
info leaks.
So in theory, because let's imagine somebody drew on the Fed. So the discount window is regional Fed. Let's assume somebody took down $100 billion from or even $20 billion from the discount window through the Cleveland Fed. It can only be PNC. so that people can figure out who it is. So why are you doing that?
Right.
And then I got a story and I got to explain it. Where I think this should go, so go back to the original where I said Fed funds is dead. Nobody trades it. We ought to just trade the discount window. Right? The discount rate ought to be, I'm just lending and borrowing all day long. I can leave money excess reserves, right, if I have money to give, and I can borrow money, discount window, when I need money. And there ought to be like a 5 basis point bid offer on that. You'd put more liquidity into the system here to grow the economy if you did that, in a great way. But it's like they wiped out LIBOR, they wiped out Fed funds through all their LCR requirements. Now you have the discount rate. Just bid offer on the discount rate. And then all of a sudden, discount window becomes a right way transaction. It's happening every day.
Yeah, the stigma goes away.
Yeah.
So you have to forgive me because there's a lot going on in the world these days, so I can't pay attention to everything. I have no idea where you stand on yield-bearing stablecoins, which I understand to be a big thing, topic of debate in the sector. And I've been paying attention to other things, but I see headlines about this pop up. From time to time.
So stablecoin legislation, Genius Act comes out. They left a little loophole in there. They said no interest, but it kind of got run around by offering rewards, promos. Same thing. Clarity Act is what's being debated right now. They're trying to close that loophole, they being kind of banks and people around banks. Keeping the loophole open is crypto. Why not? If you can pay interest, it's going to drive volume. I want to pay interest. Banks say, I don't want you to pay interest because you're going to potentially suck deposits out of the system and you're messing around with a capital system that's worked for 250 years. You sure you want to mess with it? At the end of the day, I think the following. Stablecoin has been built, launched, marketed as a payment mechanism. It's somehow going, by the way, I'm not sure it will, but it's going to make payments easier, faster, cheaper, whatever. Not as an investment vehicle, right? An investment vehicle is a different animal and needs different regulations. So all of a sudden, like a stable coin that's buying T-bills that pays you interest, that looks an awful lot like a money fund to me. And that's fine. If it's a money fund, then regulate it like a money fund. Can't break the buck. You got to have this much liquidity on hand. All the disclosure rules that go around with it, then do what you want with it. Go ahead and pay people in money funds. I just think they're mixing things, and I think, my uninformed worry is we're not done blowing up in crypto yet. Right? It's in fits and starts as you learn these things. Why do we need to start everything at once? Let's figure some stuff out. If it works and there's a logic to doing it, then go ahead and do it later. I don't know that you need to do it all at once.
What's the rush?
Yeah.
We are coming up to the super Bowl. And when I think of the Super Bowl, I always think of the Basel Endgame proposals and that ad that they ran in 2024.
It was surreal, wasn't it?
It was a very effective marketing tool, at least for me. And we are expecting a reproposal of the Endgame. What's your sense of what might change between the original document or suggestions versus now?
I have no inside information on that, but the original proposal that was written was in contempt of math. They basically had a goal of raising capital, and then they used bad math to cause that outcome, which was a lot of what the outrage was over, because if you start making up rules in capital allocation, you inadvertently cause risk to emerge in places that it shouldn't. So I think the math is fixed. The lawsuit on the stress test and the fact the models need to be public, so the math is going to be a lot better on what they measure. You've heard about indexing GSIB scores to inflation and some of the boundaries. I don't know what they're going to do on operating risk capital. It's been a fight. I think they're going to give some credit on credit risk ratings that Europe gives that we don't. And my guess is there'll be something in there for everybody. And then everybody will collectively be disappointed about something. They're not going to give away the shop, but they're going to try to make it directionally correct and based on real math instead of made up stuff.
I want to go back to something you said about the bank integration, and you actually gave a very rare, I would say, actual 2026 application of generative AI implementation, where you mentioned that the person at the local bank branch can actually like ask a question about the policies and learn. So is that wasn't just a hypothetical. That's a real thing that's happening right now.
Yeah, that's true.
Can you talk? This is a theme we've been talking about on the podcast lately, which is not just AI per se or implementing, or we're going to like implement AI, but like, the changing relationship between a company and their software vendors. And, does AI change some of these relationships? Do you have leverage because there are certain like niche functions that you could like build yourself? Can you talk a little bit about how you're seeing some of these things play out within your firm?
Yeah, this is fun because there's so much bad information out about that. So, start with the basics. In order to utilize AI, you need clean data, defined data with a single source of truth. We've spent 10 years doing that and a fortune. So, as silly as that sounds, think how many different places inside of a company you might have, a checking account balance that's then morphed into the average checking account balance over 7 days, or the median, or the this or the that. And so when someone's trying to pull data to run a report or build a model, they don't even know what they're pulling. So you got to get it clean at the base source and an index. Then now you have the capacity to build a model, whether it's large language or analytical. Large language models, there's open models out there you can just use, which is what we tend to do to build our document sorting. We're using it on our own data, our own documents. I don't need their data. And I don't need to retrain their model per se, other than running it on my own data, which is a much smaller compute factory. Right? I don't have the whole internet downloaded. I just got this thing, right? And then once we train the model, running the model doesn't take a lot of compute. Training the model takes a lot of compute. When we talk about AI, some of it's the fancy object thing. Oh, I'm going to implement Copilot, and now people can write emails for me. Everybody knows when Copilot wrote my email because it's way too polite and the punctuation's correct. Does that make us any money? Probably not. But it's cool. And so when you hear most people saying, oh, we're using AI, they just plugged in Copilot and paid somebody $20 million a year for licenses. Where it starts to make a difference is when it can answer questions in a hurry for our employees or our clients, and where it can automate process the same way we've been on this automation journey for 20 years now, right? Starting with internet and then kind of microservices and applications. AI is just the next stage of that. We over the last 10 years probably get 30 points of productivity efficiency in our operating environments. Probably the last 7 years, actually. AI is going to give us another 30. And it's going to come through time. But think of it as automation. All it is even when people talk about AI, they'll say, oh, it's an AI model. It's not an AI model. It's just a decision tree. It's automating a script and an answer, moving data in a way where somebody doesn't have to swivel, pretty basic stuff.
What about on underwriting? Would you use AI to automate that particular process?
It's actually not legally allowed today. So there's, it's truth in lending or something, one of these laws where if I tell you no, you applied for your credit card, they just capped my rates at 10%. So I said, no, I've got to give you the 3 reasons, of why I said no. With an AI model, we look at 1,000 variables, and the weight of each of those variables is dependent upon their interaction in your particular profile. So the weight of rent might be very heavy for one person and not for another based on the profile. I can't give you 3 reasons. The model told me no. The model told me yes. So what ends up happening today in credit decisions, this is crazy, but it works, is we'll set with our normal criteria, this FICO, this debt to income, whatever else you look at, we'll say yes or no. And then if we tell you no, we'll use AI to try to tell you yes. Because I can still use my original excuse as no, but if I turn you to say yes after the fact, you're not mad at me.
So the point is,
It's crazy.
But the point is that legally speaking, if you say no, you have to be able to articulate a reason.
Yeah, so what ends up happening is everybody sets this bar way too high. This is one of these silly rules that needs to be looked at. I mean, we do use, it's not so much AI. There's a lot of decision tree models on automation that help with underwriting. But it's not necessarily a machine learning application.
Tracy and I find I get this idea of like AI as another form of workflow automation, very intuitive.
Yes.
Tracy and I used to publish transcripts of the podcast, but it was a very labor-intensive labor-intensive process to like clean it up, et cetera. And so I thought like AI was going to be the panacea. It's like clean this text. It just, when we were doing it, it wasn't there yet. It was like creating sentences that weren't there. But I understand this intuition that AI can then be like trained on a repeatable process. Right now, and again, the things that we call AI, which these days, large language models, those workflow automations, like are there certain workflow automations that today, workflow processes, that you could say, we've been able to automate them in a way we couldn't have 5 years ago?
Oh, absolutely. But let me just give you kind of some scope and some numbers and what's actually happening. And we have a pretty clean tech stack, so maybe we're a little further ahead at this than some. But we have we focused on $1.4 billion of addressable spend inside of our care centers and our operating environments. This is just solving problems for customers, moving all that stuff. $1.4 billion we spend. We've come up with 171 different ways to use AI in reducing that spend. And the addressable piece of the $1.4 billion, we think is probably 40% of it. Of the 171 use cases, we prioritize 5 that are live. And so what does one of those look like, for example? So imagine inside of our wealth business, we got a bunch of trust lawyers. So my grandfather, it's actually with PNC, my grandfather created this small little trust, skip generations, and it's beautiful. It's handwritten on like 3 pages. Maybe it was my great-grandfather. Some lawyer every month has to look at that thing and say, this qualifies or doesn't, or we're going to do this distribution. All of those things are manual. Now just read them into the document writer, and all of the things that are mechanical outcomes from those millions of pages of trust documents are right in front of you, right? Payment on this date, here are the beneficiaries. It makes it real simple. So document reading, expression of what's in documents on the basic stuff. Now I don't have to just go and search and find and human error. That stuff will make a difference. I worry we have too much focus on the cool, fun toy. ChatGPT, this is, it's a new Google search. It's cool. Yeah. Give me the answer. That isn't going to make the world better if that's all it's used for.
How did you get a clean tech stack? Because this is something that also goes hand in hand with bank consolidation. You always hear that, banks end up with this tangled mess of technological systems, maybe some that include COBOL or like old languages and things like that. COBOL? I can never remember.
You can't even, you weren't even born yet when we were programming in COBOL.
So how did you manage to do that?
So honest answer, right in the middle of the financial crisis, right, we merged with National City under duress from both firms, kind of a regulatory wedding. Neither of us had the capacity to run a larger firm. I distinctly remember, talking to the combined organization, we have to rethink how we run something. You can't manage by walking around anymore. And neither tech stack could survive on its own. And so we saved less money than we said we would in the announcement, or actually we saved what we said we would save, but quietly we reinvested $2 billion a year for 10 years.
Wow.
Yeah, so literally all new, we went from single server stack so this computer runs that application, and each computer is different because whoever the application owner was went to dinner with Dell that day or HP the next day. We had 11 data centers. None of it was in a virtual environment. So building our own first cloud environment And then secondly, writing everything in cloud language, in a microservice application, so it's cloud native. That's forever. But we spent a ton of dough and just have invested, and got to a place where our tech stack is as modern as any fintech you'll find out there.
All right. Well, Bill Demchak.
This is fun.
This was a lot of fun. Thank you so much for taking the time. We had a lot of
questions.
questions.
Thank you for being
banks
interested.
Yeah.
No, that was great.
That was great. Really appreciate you coming on Odd Lots.
Yeah. Good to be here. Thank you.
Tracy, I really enjoyed that conversation. I learned a lot about banking in that conversation. We hit a lot in that. But I just wanted to keep going. There were so many interesting angles.
Bill actually answered the questions.
Which cannot be said for every CEO.
No.
I would say most of our guests are very good at answering questions. Not every CEO is great at always answering questions, but I was like, oh, I'm like learning something with each one of these things. Let's keep going.
Also, genuinely, he seemed to have a good handle on like the granular and practical aspects of running a bank. So I was really interested to hear how they redesigned their tech after the financial crisis. I guess they got a head start on everyone else.
Yeah.
And then also the pre-positioning of collateral at the discount window. I knew that the Fed had been encouraging banks to do it. I did not realize that you had to send the actual mortgage docs if you want to borrow against those.
It is crazy how much is not just done automatically, electronically, right? And here was, I didn't ask it, but I was going to ask, does blockchain solve this question? But the idea that, like, okay, all of these things really are electronic-ish, although there's clearly this physical component. But the idea that here is something which is theoretically monetizable, which has liquid value, is a liquid instrument, but because of the way that the system is structured, cannot actually be liquidated or turned into liquid assets immediately if it were not pre-positioned, etc. That actually does still seem a little bit wild to me that is the case.
I always thought that mortgage assignations were like one use case for blockchain, right?
Right.
Like you could reasonably see blockchain, helping out with that problem versus, I don't know, tracking the origins of lettuce and things like that always seemed kind of ridiculous.
Well, it seems like one of these things which is in banking and again, it's like integrated databases. So there's like be a central bank database, there will be a home loan bank database, and the regional bank and the bank database, right? And the question is like, why can't they just all
talk to each other?
Yeah, or see the relevant parts of the database, right? And I suppose that's easier said than done. I really liked hearing him talk too about practical applications of AI, which again, maybe it feels a little different than some of our conversations last year, where it feels like now there's more articulated examples of being of this is a sort of labor-saving or time-saving technology. So that's another thing I think we have to pay more attention to in 2026.
Okay, shall we leave it there?
Yeah, let's leave it there.
All right, this has been another episode of the Odd Thoughts podcast. I'm Tracy Alloway. You can follow me at Tracy Alloway.
And I'm Jill Weisenthal. You can follow me at The Stalwart. Follow our producers, Carmen Rodriguez at Carmen Armin, Dashiell Bennett at Dashbot, and Cale Brooks at Cale Brooks.
And if you want more Odd Thoughts content, then you should definitely check out our daily newsletter. You can find that at bloomberg.com/oddlots.
And you can chat about all of these topics 24/7 with fellow listeners in our Discord, discord.gg/oddlots.
And if you enjoyed this conversation, then please like the video or leave a comment, or better yet, subscribe.
Thanks for watching.